Mr. President, together we can build on the best of what this relationship has been in the past to create a new one, adapted to new global realities that will deliver stability, security, and prosperity to our peoples on both sides of the Pacific.
We did have a good meeting, and a long meeting as well. We had the formal parts, we had some informal parts, and then we continued over lunch. And so the relationship is in a good place, a strong place. And what I'd say to everybody here is that I always act in our national interest. And therefore the question for me is, how does this accelerate and deliver back at home? I know that whatever's going on in the world, the most important thing to the vast majority of people is the cost of living. So opening up access to business, opportunities, seizing those opportunities, which then gets reflected in better businesses, in jobs, in price reductions at home, really, really matter. And so we made real progress on all of those areas.
In global trade, major shifts rarely begin with dramatic announcements. They begin with small adjustments, a limited agreement here, a sectoral deal there, a quiet visit that doesn't dominate headlines. But when several U.S. allies make these adjustments at the same time, the pattern becomes economically significant. Canada expands its commercial ties with China. The United Kingdom signs targeted export agreements. France and Germany continue deep sectoral cooperation. None of these moves represent a break with the United States. But together, they reveal something important about how middle powers respond to tariff volatility, policy uncertainty, and rising economic concentration risk. This video examines the structural incentives behind these decisions and what they tell us about the future of the global trade system. Over the past year, Canada, the United Kingdom, France, and several other U.S. partners have expanded commercial engagement with China. These actions are modest individually, but collectively they illustrate a broader adjustment in the global trade system. The United States remains the central economic partner for many of these countries, but the incentives are shifting. When the cost of relying on a single dominant market rises, diversification becomes rational. This is not a political realignment. It is a structural response to changing economic conditions. The shift became clearer after Canada finalized a limited arrangement with China. Washington responded by threatening a 100% tariff on all Canadian exports entering the U.S. market. The official justification was trade diversion, the concern that Chinese goods could enter the U.S. through Canada at lower tariff rates. But the scale of the threat signaled something broader. U.S. market access is now more explicitly tied to political and regulatory conditions. For Canada, this created a new risk variable. For the UK, it created a new precedent. For Europe, it reinforced a long-standing trend. When tariffs become a primary policy tool, the volatility of relying heavily on the US, market increases. And when volatility increases, diversification becomes a form of economic insurance. Canada's response was economically significant. It did not escalate. It did not retaliate, and it did not reverse its agreement. It simply continued implementing it. This reaction demonstrated a key structural point. When a country has multiple trade channels, the cost of pressure from any single partner decreases. Canada's quiet confidence sent a signal to other middle powers that diversification reduces vulnerability. The United Kingdom's visit to Beijing fits the same pattern. London did not pursue a full free trade agreement. It did not signal a geopolitical shift, and it did not challenge the United States. Instead, it sought targeted export gains, sector-specific cooperation, incremental market access, and predictable commercial channels. For a post-Brexit economy facing slow growth, supply chain restructuring, and tariff exposure, diversifying trade partners is a practical decision. The UK's logic mirrors Canada's. When tariff risk rises, the value of alternative markets increases. France and Germany operate under similar incentives. French firms rely heavily on Chinese demand in aviation, agriculture, and luxury goods. German manufacturers depend on China for industrial inputs, machinery exports, and consumer markets. The European Union maintains multiple agreements with China, including the Geographical Indications Agreement and long-standing sectoral dialogues. Europe's strategy is not new. It is a continuation of a decade-long approach: engage economically, compete politically, and avoid dependence on any single power. This doesn't seem like a pivot, it is a structural adjustment. From Washington's viewpoint, three economic dynamics are converging. First, allies are hedging, not defecting. Diversification reduces vulnerability to tariff shocks and policy swings. It does not eliminate U.S. influence, but it reduces the cost of disagreement. Second, China is positioning itself as a stable commercial partner. Beijing emphasizes predictability and non-interference. Whether or not this is accurate, the perception matters. In trade, perceived stability influences investment decisions. Third, the United States is approaching the USMCA review. North American supply chains are deeply integrated. A tariff conflict with Canada would raise costs for U.S. manufacturers, disrupt cross-border production, increase consumer prices, and create political pressure during an election cycle. Stability is economically valuable. Escalation is costly. The United States now faces a structural choice. It can escalate and use tariffs to enforce alignment, increasing leverage in the short term but encouraging diversification in the long term. It can recalibrate and reduce tariff threats to stabilize supply chains, lowering volatility but potentially reducing bargaining power. Or it can wait for the USMCA review and use it as a structured pressure point, delaying conflict but not resolving underlying tensions. Each option carries economic trade-offs. Meanwhile, middle powers are adapting. Canada continues its quiet diversification. The UK expands targeted commercial ties. France and Germany maintain deep economic links with China. The EU preserves its long-term frameworks. None of these countries are abandoning the United States. They are reducing single market exposure in an environment where policy volatility has increased. This is not defiance, it is risk management. The broader pattern is clear. The global trade system is becoming more distributed. Middle powers are increasing economic optionality. Market access is becoming less binary and more diversified. Alignment is shifting from automatic to conditional. Economic power is no longer concentrated in one capital, it is spread across multiple nodes. This does not diminish U.S. influence, but it changes how that influence operates. The actions of Canada, the United Kingdom, France, and other U.S. partners do not signal a geopolitical pivot. They signal a shift in economic strategy. When tariffs become unpredictable and policy swings widen, diversification becomes a rational response. And as more countries build additional trade channels, the cost of relying on any single market increases. The United States still holds substantial leverage, but leverage operates differently in a world where alternatives exist. The upcoming USMCA review will be a key test of how Washington balances enforcement, stability, and long-term competitiveness. The broader trend is clear. The global trade system is becoming more distributed. Middle powers are increasing their economic optionality, and alignment is shaped less by political loyalty and more by structural incentives. Understanding these dynamics is essential for interpreting where the next decade of global trade is heading. This is Tradeconomics.